Good evening. My name is Peter Resnicek from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly for Sunday, May 2nd, 2021. It's a very interesting juncture in the markets for me personally because it's the first time in a very long time that I don't have any positions on in the market going into next week in my main trading account. Now, a little bit of a caveat here. A lot of that has to do with the fact that we just came off of a big Fangman plus T earnings week where almost all of those big tech names reported all in one week. And those of you who follow my trades and my style, you know that I don't do trades going into the earnings that often right after because of gaps. The charts are a little bit wonky, so I don't do them after that as well. So it's a little bit of a wait and see for me on that front. But in this video, I'm going to be doing some analysis showing you another part of that equation of why potentially it doesn't feel like the right time to be putting on some new stuff in the market. A lot of that has to do with a phenomenon called look above and fail, which we saw in the futures market late in the week. There was a 3-day balance that we broke out of and then came back into range. I'm going to be dissecting that. I'm obviously going to be looking at the daily charts of the S&P, Nasdaq, and Russell specifically, because if you recall, last week's video dealt a lot with a head and shoulders pattern in the Russell that I thought was failing. So it was kind of a failure of a bearish pattern, which would be bullish. But now this week kind of fell back into range, not so much. So we'll look at that. We'll obviously look at Fangman plus T. And then we're going to end kind of looking on a bottom-up approach as opposed to a top-down approach. We're going to start granular, and then we're going to go kind of wider at the end. We're going to end on monthly charts because it is the end of a month of April. And obviously we have completed monthly bars now. So we'll look at all the major averages and also all of the 11 sectors that make up the S&P 500. We'll look at their monthly charts as well. Without further ado, let's get into it. So in the video, I mentioned that there would be monthly charts, and you would probably expect me to start there with like a whole top-down analysis, you know, starting with a longer time frame. But that's actually not how I operate. Those of you who know me and follow my trades in my advisory, you know that I'm a short-term trader. So what really matters more to me is the nuance, and I actually look at things the other way. I'll actually look at shorter time frames, and then I'll go into longer time frames later to see if there's confirmation. There's two kind of different ways that obviously you can look at that. So starting with something that's very granular, what I wanted to point out here that I feel is very important is the fact that we had a look above and fail. And a look above and fail basically is something from what we call balance rules. And balance rules and gap rules and these different frameworks are really, really important for traders to learn because it gives you a frame of reference when you come into a market that avoids you falling into the trap of what I call shock and awe. Shock and awe is when basically a market does something that you don't expect because you don't have the education, you haven't seen enough markets, you're not ready for it, and then you end up making bad decisions. So let's talk about balance rules first. Balance rules are essentially when a market is in balance and you have a number of days like you have here, where ranges are relatively equal, as you can see here, ranges are relatively equal. And when you look at where the majority of the volume and time was spent on the market profile on the futures chart, it's also very overlapping. It's very tight. So obviously, if you're just looking at traditional candlestick charts, it's easy to see what is a balance here. You might have 3 dojis or 3 very small days kind of in a row. But on the market profile chart, because it adds that extra element of time, and the way it lays out also for us where the value area is where 70% of the volume roughly of the prior days, of the day's session rather, traded, I think it gives us a better idea of balance. So here, I'm calling this the 3-day balance area, which should be obvious because you have 3 value areas, as I said, almost identical, and also the ranges are almost identical. And I called the high of the balance area here on the top of that April 28th and the low of the balance area here. Now, the way balance areas work is basically there are only a finite number of outcomes of what happens after balance, right? Everybody thinks breakout, and usually they think breakout up, obviously, if the trend is up. So obviously the first scenario is what we call look above and go, right? Where you look above price and you go, and that's obviously the first scenario. The second scenario would be that you could look below and go, meaning break down below and go lower, or you could also just remain in balance. That's obviously a scenario. But then once you break out of balance, you have to be cognizant of what happens if you go back into balance. And this can have short-term ramifications and also have long-term ramifications. And when I say ramifications, you should be thinking opportunity. You should be thinking in your mind, aha, if I have a rule set that I can follow that's going to tell me what the market potentially could do, I could set up a trade. So classic example is what just happened. We had something in the balance rules called look above and fail, which is obviously different from look above and go, because the market didn't go, it actually failed. So we looked above balance here on Thursday, and we fell down into balance, or rather back into balance. But interestingly enough, on Thursday, which made things kind of tricky, is that we closed outside of balance. The red circled area is the settlement, which is the 415 mark in the futures. We closed out of it. But if you look above and come back, and we did come back into range on Thursday, but like I said, we just rallied and closed out of range. So we didn't satisfy the entire look above and fail, because the target of a look above and fail is coming back into balance and rotating down to the opposing end of balance. And this is important to note, that sometimes this can be delayed. It doesn't have to happen all at the same time. So in this case, it happened on Friday, where we went to here, where we actually tested the low end of balance, but then we closed back up in balance. We didn't actually break down through, even though this was happening on Friday relatively early enough in the day where we certainly had plenty of time to break on through. And this is why, to me, on a very short-term level, the market is really not giving many signals now. On the one hand, it seems like, could we just say, okay, well, this was just, this sort of look above and fail was an anomaly, and basically the market is still balancing, nothing is happening? It's hard to say. We don't know. Could we say, okay, well, the market is getting tired here, and obviously this area, when you look above and fail, you kind of look at this entire area as what we call excess, like an excess high, and there's a little bit of true excess on the top where you have the single prints. Could we look at it like that? Say, okay, this is an excess high, and we're going to move lower. Again, it's very hard to say at this juncture. I would have thought that when we did the look above and fail, and then we set up for the move to the low end of balance, which we got, we had the classic rotation. And again, I talk about framework, I talk about rule sets. These are the things that can set up a trade, right? It would have been a hard trade to pull off because, like I said, we went down and back in and back out. But eventually we did go to here, correct? And it made sense that we would go to there. A classic thing that I do in weekly options advisory and in my own trading is, when I see a look above and fail, I've done this many, many times, and it's almost always successful, is I'll set up a butterfly with short strikes at the opposing end of balance. When I see the look above and fail, I use the very short-term Monday, Wednesday, Friday expiries that we have available to us in SPX options, and I'll put on either a straight butterfly or a broken wing butterfly, or if I'm feeling extra frisky, maybe a ratio spread, right? I'll leave the risk open-ended on the bottom and say, okay, it's just going to be a +1 here and a -2 at support, and we'll see what happens. But usually straight butterfly is the way to go. And so you see how, not only from a day trading perspective, but even from a slightly longer term perspective, like using weekly options, you can set up trades if you really understand these concepts and you know exactly what the market is actually doing, and you're not just throwing up your hands and saying, oh, this market's crazy, or, you know, it's just, it goes up and I thought we were breaking out and then the breakout failed, and, you know, I got long here on the breakout and I was making money, it was great, and then I had to dump it, break even, I got out here, and then you don't do anything else after that, or maybe you don't get out, and next thing you know, the market closes down here, and then you're going home, and maybe some of you are in this position right now, you're going home over the weekend with a long that you're nervous about. You're probably not going to be sleeping well on Sunday night, depending on how the futures open. I don't know what's going to happen, up or down. Do you see what I'm getting to? It's like, you're not using all the tools at your disposal and all of the market-generated information that the market is actually giving you to make better decisions. All right, and that's really what I feel I bring to the table when I speak to you on these videos, and, you know, not for nothing, but, you know, I'm kind of flogging my subscriptions, you know, in between all of the free information that I'm giving you. I just keep saying over and over that this is what I bring to the table. So if you want to take a 5-day free trial to the Peters Pre-Market Perspective, where I write about all of this stuff every single morning and you get it in your inbox at 9 a.m., feel free. Hit up our website and mouse over the Futures Market Profile tab, and you can see here on the screen is a sample of what the newsletter looks like every morning. And I talk about these scenarios before they play out, saying, okay, this is what the market's telling us. So potentially today, this could happen, or this could happen. And I hope some of you noticed we now have a new format to the newsletter as well. It looks a lot prettier. I've added a section, as you can see, called Pre-Market Indications, where I break down the overnight inventory situation, 100% net long, 100% net short, where we're opening in relation to. Basically, when I answer the 3 pre-market questions that everybody should be using, basically, right? Those 3 pre-market questions are very important as well. And again, what do? They set you up with a framework and a rationale so that you can make better decisions during the course of the trading day. Remember, as I've always said, and I'll just end on this note, in writing my report every morning and in looking at all this market profile and market generated information and sharing it with everybody on a daily basis, all right? Obviously, it's before the market opens. I don't know what the market is going to do. I just know what you should be thinking before the market opens. So now let's shift gears and we'll kind of move up a step from the most granular look at the markets, which would obviously be the market profile, and we'll come up into daily charts on the majors. So let's start with the S&P here. I'm looking at a SPY daily. I can switch to SPX. It doesn't really matter. But you can obviously see the look above and fail up here and coming into range. And first thing you want to notice is obviously there is no, and I have to really emphasize this, there is absolutely no technical damage to this chart whatsoever. So remember from the introduction in the video, what I was saying is that my reason for not having any trades on going into next week has a lot to do with the fact that it was all Fangman plus T reporting last week. And obviously I don't like to trade those stocks, and those are my favorites. I do most of my trades in those names. I don't like to trade them going into earnings, and then obviously some of them gapped, so the charts are kind of wonky right now. So I'm not doing anything. But I am still thinking that there is potential here that maybe the Nasdaq needs a little bit of cooling off, which often happens after the earnings cycle. It's usually a ramp up in, and then it's kind of cools off, and then things get ready for the next earnings cycle. But all of that being said, just everybody notice that there's no technical damage here, and the simple stuff that we look at in terms of moving averages stacking, like is the 20 again above the 50, everything is still super bullish. One thing that is noteworthy is the distance from the 20 to the 50. Notice that the 20 is pulled away because this move is so steep. So that could be a little bit frothy. And obviously we could have a pullback to the 20, but even the trend line here is still so far below. There's still room to the trend line. And I kind of draw this line here just to show that the pullback low here would correspond with a trend line pullback. Let's look at Ndx. Consolidation. And again, this is all just stuff to carry forward. You have a large balance area now. But what I think is noteworthy about this, and again, this all kind of ties in with my idea of kind of taking my foot off the gas, but not full on bearish. You know, I'd rather have no position than not really know for sure. The rise in the Ndx in terms of breaking out was just very weak, like nothing happened. There was absolutely no breakout. And this is noteworthy because think about it. All of those Fangman plus T stocks, or mostly all of them, this is Nasdaq 100 right here. Like if Fangman plus T reporting didn't take this index higher, then my question is, what's the catalyst going forward to get us higher in the near future? So it's something to think about. And also notice that the pullback in the Ndx came to the 20 MA, whereas when we just look at the S&P, it wasn't to the 20 MA at all. We're still above it. Okay, now let's get into the rut, because when I talk about the Russell here, I want everybody to remember my comments from last week. If you remember last week, I showed you a chart of the Russell, and I said this was a head and shoulders pattern that was bearish, and it took us right about to here, right? We were looking at these before these 5 days of concern. This is what the chart looked like in the rut when I spoke of it last week, and I said, I think that this head and shoulders pattern is failing, which is bullish. And I was right for a few days. And if you recall, I said that I had a debit position on in the IWM that actually worked out well because we got out of it here when I saw that it kind of looked above this little 2-day balance and failed. I exited that position for a profit, which was good, and in hindsight turned out to be very good because you can see the Russell broke down. So in the same vein as I was talking about that if this was a head and shoulders that was bearish, this right here shouldn't have happened in a bearish head and shoulders. I will also say that I think that if it was a failure of the head and shoulders, which was bullish, I don't think this should have happened. To me, it seems like this is kind of a very weak price action that sort of rolled it over. So my bias in the Russell now has moved from bullish to neutral. And I will simply watch next week how the small caps will react to this particular trend line here. If we go to it, as long as we're able to hold above it, I will maintain that sort of neutral to slightly maybe even bullish bias, I don't know. But if the Russell was to break down below this trend line, note that it will open up potential for a move to down here, or at the very least to retest this prior support line where this prior low was. Notice that the rut had a very long run here without any sort of major pullback, where it constantly stayed above the 20 MA all the way to here for a very long time period. So this is all just stuff to carry forward that I think is very, very important for next week's trade. All right, let's take a quick detour into Fangman plus T here in this section, only because it just ended the hot and heavy earnings week, which I think is the most important earnings week. I mean, for me, the way I trade, it's really the only one that I pay attention to in terms of all of when the Fangman plus T. All of the Fangman plus T reported last week, or most of it, leaving only NVIDIA. NVIDIA is the only one that hasn't reported yet. They come on a little bit later, but at this point, everybody in the Fangman plus T besides them have reported. So let's take a look at these stocks individually. And this, I think, will tie in with what I was saying very clearly, that I think the reaction outside of Facebook, which you're looking at right now, has been kind of lackluster. Facebook had a huge gap up and for now has held it. But let's look at what some of the other stocks did on their reports. Look at Apple. Very similar to that kind of look above and fail in the NDX. You had this big balance area and it just came up a little bit over and then crashed down, and now you're sitting at the low end of balance. So, and also under the 20 MA. So pretty lackluster. Obviously, the buy point in Apple is going to be obvious. You know, once we break out of that balance area to the upside, we could go here, but there's really no reason to be taking a position right now. I don't think. We can just wait and see what happens. Amazon did gap up but failed. As you can see, it was obviously a gap and fail. You gapped up to here, you went to the prior high and then made a pretty ugly candle, which I would think would indicate distribution on a pretty solid increase in volume on those two important days where we came up into earnings, and then the day that after they reported. So pretty interesting there. There's some room to come down to the 20. I don't know what the outlook is, but I wouldn't do anything with it here either. Not that impressive. Let's look at Netflix. Just looks very ugly. I mean, they didn't do anything. It was kind of an ugly reaction to the numbers, and they just have a balance area going on here. Obviously, if that balance area was to break out to the upside, I'd probably possibly look at some sort of a butterfly here with mid strikes targeting the gap fill, just kind of thinking aloud. The stock was very relatively strong on Friday, but I'm saying overall, if we're looking at this Fangman plus T as kind of a benchmark for what tech is doing and where the market may be going in the future, I think it's relatively lackluster right now. I think, it was a lot of kind of buy the rumor, sell the news. Google, big gap up and now failure, kind of coming back into range. But the main area to be looking at is here, is what happens with this balance area. Does the balance area top hold? I would imagine on the first bounce it will, but then if you go back down through, we'll see if there's potential to go lower. I don't know. Obviously, it's still bullish for now. Let's look at Microsoft. Not a good reaction to the numbers, even though the numbers were good, and big gap down. Let me just get my drawing tool right here. Big gap down, and we'll see if we come into here. This is obviously the key area in Microsoft going forward, is to see what kind of bounce, if any, you get at the prior high, which is the breakout point. That's pretty simple technical analysis, is those prior resistances should become new supports. And then obviously we've got the trend line support there. I mentioned Nvidia, which has not reported yet. I don't think the chart is doing much of anything. And last but not least is Tesla. They also did not have much of a reaction to their numbers. They have held this particular trend line support. Oh, excuse me, this is driving me crazy. There we go. They have held this particular trend line support here thus far, but if it gets lost, it's probably going to the 567 area. So as you can see, a lot of these stocks to me are kind of a wait and see. Obviously, because I'm a short-term trader, I will figure out something to do with them. Those of you in my weekly options advisory, you will be seeing that in real time sent straight to your phone. But as I said in the intro, right now I have no positions in any of these stocks, and I actually have no positions in any stocks, as opposed to obviously some longer term stuff. But in my trading account, I have nothing going on for next week, and I will just be taking it as it comes. I will be taking in as much market generated information as I can and making decisions on that market generated information. And when an opportunity presents itself, I will certainly do something with it. But I think it is at least noteworthy that for a very active short-term trader such as myself, I do not have any positions going into next week. Which of course brings us to these monthly charts, which I said I was going to end on. Since we're kind of going backwards instead of a top-down approach, this video is going bottom up, and we're going to end on the long-term charts. And this is a good thing to do at month end, basically. Now we have a completed monthly candle. April is behind us, and the next trading day will be in May. So let's start with the top. SPX. Bullish. You'd have to say it's bullish, but monthly candles can end bullish and then have a bearish month behind them. You can see that here. That does happen. Look at like here. I'm just throwing up a couple of little examples so we don't know. We didn't get any sort of a tail, and that's important. I often speak about these tails only in the longer term time frame. I'm not a big hammer person, inverted or bottoming or whatever, but I do look at shadows in weeklies and monthlies. I think they can be powerful on the more longer time frame. So I guess very, very bullish still, but also if you look at from the close, super duper overextended from the 20. I mean, this is the furthest that we've seen it in some time. Even here came in a bit, not so overextended, not so overextended. I mean, this is just a very big distance on the monthly charts from the 20. Let's move on to the Nasdaq 100. I think this is a little bit more bullish than the predecessor that we just showed of the S&P, only because you had 3 months of balance here, and I didn't quite draw that right. I drew in this one green candle. But this is 3 months of balance in here where it paused and then went higher. So we shall see. We'll see what's up. Let's look at the rut. And now here's where things get interesting, because we have a number of shadows on the rut. I'll just get rid of everything so we can see it more clearly. We have a number of shadows in the rut. You've got some tails, and notice that the rut in April did not make a higher high in relation to the March high, whereas the S&P did. So you may be seeing a little bit of that sort of lag in the small caps, which I do believe are a somewhat leading indicator. And it's like the understatement of the year to say that the rut is a little bit overextended from the 20 on the monthly. It's extremely overextended. So again, all market generated information that we can carry forward. Okay, now let's move into some of the sectors in the S&P. XLK, a little bit of a tail. That's tech. Obviously, that's going to be a big driver of the Nasdaq 100. And I'm going to kind of go down in order of their weight. So we're going to be looking at, like, for instance, XLK, which is almost 30% of the S&P. Then we go down to healthcare, which is like 14%, etc. So XLV, let's look at healthcare on the monthly. Looks all right, not too overextended. We'll look at all 11. XLY, consumer discretionary was very strong. This is kind of on the heels of that rotational trade where, you know, tech was pulling back for a bit, but you can see here last month the consumer discretionary really stepped it up while the tech was still lagging. XLY on the monthly looks great. Consumer discretionary, that's XLY. XLC is communications. Oops. XLC looks good. Overextended from the 20 for sure. XLF. Financial still looks good. Looks like the S&P as you would expect, but overextended from the 20. XLI is industrials. They look just fine. XLP is staples. They've had difficulty breaking out. Seems like a very congested chart to me. materials. Now we get into the sectors that don't have a whole lot of weight in the S&P like the last few, but materials look good. XLRE, real estate looks fantastic, but again, over a bit extended. Energy is lagging. It's definitely having a problem, but again, this is not as much of an issue for the S&P because it's only about 2% of the entire S&P 500. But I would think that if energy stocks move a bit higher here, they would probably be a short on the backside of the trend line. So just keep that in mind. I think also crude is in the 60s. So I don't know, let's say crude was able to stage another rally, which I don't really see happening, but it could from here. And maybe you get a little bit higher to like $70 crude. Then obviously these energy stocks coming into their downtrend line and the backside of this kind of channel, if you will, or the backside of that underside of that uptrend line could be a short in energy there. And last but not least, utilities. Utilities are not at the highs, which is, it would be a more bearish sign, I think, if utilities were like all the way up here. But again, not a big weight in the S&P, so they don't matter all that much. And that's all for this week. Thank you, as always, for spending just a little bit of your weekend with me. So let's recap some of the key concepts that we talked about in this week's video. Firstly, I want everybody to understand very, very clearly, this is not a bearish call. Remember, cash is a position, and every now and then, if you don't know, you don't know. So it doesn't, you can always take a little bit of a breather. And I don't know, for me personally, how long this little breather is going to last, because I don't know what the market is going to tell me next week. And you should understand when you're hearing this that I'm trying to get you to think that it's the market that tells you what to do. You should not be coming into the market with some sort of idea that you are going to do something. You should always come into the markets with the idea of just being open and just being very fluid, and let the market tell you what the next move is going to be. All right? The look above and fail in the ES, remember, it's just one data point. And it's important to note that even though it did what it was supposed to do, meaning rotate down to the bottom end of that 3-day balance area, it also didn't break. And on late Friday, we rallied and closed kind of in the middle of that balance area. So we'll see. We know what the obvious short point in the market is going to be early next week if we were to break out of that balance, but we don't have that yet, okay? Major averages, somewhat divergent. Are they overextended? Yes, but we've seen the market stay overextended for long periods of time. I do put a little bit of weight, however, on that Russell failure, and that's why I wanted to mention that specifically. As bullish as I was last week on the Russell, I'm not so much bullish. I'm going to be watching those small caps carefully to see what happens with them, all right? Lastly, Fangman plus T. It's very, very typical that Fangman plus T, big tech, has a big run up into earnings, which they did, then it gaps or whatever happens, and then they're kind of lackluster after that. So think of door number 3 here. Remember, door number 1 is market goes up, door number 2 market goes down. What I like to call door number 3 is that maybe market potentially goes sideways for a while, right? If the Nasdaq can't ignite further, if it was a buy on the rumor, sell on the news, and now those stocks are just kind of going to rather kind of cool off for a bit and go sideways, well, that's obviously going to have a big impact on the market as well, all right? Last but not least, on the bullish side of the equation, I want to leave you with this particular photograph right here, which I purposely took for you guys earlier in the week so I could feature it rather in this video. And you'll notice that it's a chyron of what Jay Powell said in the FOMC announcement that happened earlier this week on Wednesday. This was in the press conference after. Okay, this in the bigger picture is what the market really likes. I will say that, and that is important to note, that in the bigger picture, the market cares so much about whether or not there will be easy money or not, whether QE will continue. As you can see here, he's talking about bond buying, that it's going to continue, and it's not time to talk about tapering that down at all. No talk of that whatsoever. So obviously these meetings come every 6 weeks. Keep that in mind. But in the bigger picture, this is what I think the market cares about most. But at the same time, it does not mean that the market can't be lackluster, for the next while, short-term period here, because of what I was saying about this Fangman plus T. So remember, all of these individual things that I talk about, each one is one data point. The market as a whole will react when many of these data points come together, and when many of these data points decide to get synchronized and move together in the right area, right? Meaning that you have multiple data points that are bearish all pulling together, that brings the market down. You have multiple data points that are bullish, that brings the market up, okay? Just remember that. Each item that I'm discussing in the video is one data point, and it takes a lot more than one data point to move a market. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.